how a skia grows faster. And I think this is the start of me trying to slow down a little bit because I automatically assume that everyone knows what a skia is. We talk about skia so much on this channel that everyone knows what I mean when I say skia, and that's not true. So all a SKIA stands for a secure compound interest account. All that is a life insurance policy, a type of life insurance policy. So the whole goal for today is how this particular life insurance policy grows faster. But still, let's break down SKIA a little bit. Let's kind of dig into some of those details that again normally I would blow right through. Again, a SKIA is just the acronym SKIA just stands for a secure compound interest account. There is many types. It's an umbrella. It's a bucket, like meaning there's different types of SKIAs, and not all of them are the same. And as a matter of fact, this list you see isn't the only list. So an FIA, a FIA, that's a fixed index annuity. An IUL, an index universal life insurance policy. Your savings account is a secure compound interest account. And again, what do I mean? You have money in this account that securely grows, securely compounds. Your money makes money, and the money that your money makes more money. Now, does your savings account make a lot of money? And then there's a high yield savings account. So my point is, all I'm talking about here is nothing profound or special or particular. It's pretty general, and that is, oh, there we go. Um, whether we're talking about a savings account or an index universal life insurance policy, I'm talking about for today's example, I'm talking about a specific type of SKIA. What type specifically am I referencing? Let me get my pointer here. I'm talking about a leveraged IUL. So there are many types of SKIAs, but what I'm referencing today is a leveraged IUL. Notice any of the words that kind of jump out being similar, meaning um, index pops up a lot. Got index, got index. This leveraged IUL is a type of index. So index jumps out a lot. So why a leveraged IUL compared to an annuity or compared to a regular IUL or compared to a high yield savings account? Why? Like, what is it about it? And notice what I am not listing here. Again, this is a type of life insurance. I'll call it most people in social media land have been hit with a whole life policy and infinite banking. Notice I don't have whole life in this list. Why is that? Like, what is the reason? So again, why an IUL? Why a leveraged IUL? And what is it about a SKIA that makes it something that I kind of want to kind of I guess go through or break down? So what is it? It's the growth potential. What the reason we want to use a SKIA or a leveraged IUL to be able to kind of break down things today is because of its growth potential. What is the growth potential? Well, if we were to compare, again, make an apples to apples comparison between a whole life policy, an index universal life policy, and a SKIA that I'm referencing today, again, which is just a leveraged IUL, what's the difference? Well, people love whole life policies because of their guaranteed growth. So that guaranteed growth is somewhere between 3 and 4%. I think it might even be a little bit higher than that for some, maybe 4.8 or something like that. But on average, somewhere around 4%. But that's guaranteed growth, which is awesome. An IUL, not all IULs are the same. It has to be properly structured. If it's properly structured, you can get on average about 7% growth. And where am I getting this number from? Well, if you look at the performance over the last 15 years of some properly structured IULs, that is what's being achieved here. And notice, these two items are actually the growth potential is very similar. It's not the same, it's very similar. And then that participating loan. With cash value life insurance policies, what makes them great is your ability to leverage your money now. Use them as, I'll call it, a living benefit opportunity where you can leverage the cash value that's in it to be able to use and do infinite banking, pay a bill, do velocity banking with that leverage. Like, there's many different things you can do with the leverage. Well, that leverage is just, how do you access the leverage inside of those policies? Through the form of a participating loan. Notice the difference in the cost of that for participating loan, meaning that cost to borrow inside of each one of those policies. It's different. In most cases, inside of a whole life policy, the growth is less than it costs you to leverage your money. So if we're talking about secure compound interest, your money making money, and that money that your money makes more money, whenever you go to access your money inside of a policy like this, you're losing money. So that's why I don't have it in my list of skiers. Some people might. I don't. This is my opinion, purely my opinion. And when we talk about growth inside the policy, again, inside of a whole life policy, you're losing money. But inside of an IUL, you have the ability to still make money inside the policy every time you leverage a dollar. And in the skill that we're talking about today, the leveraged IUL, that growth is even greater. So if you were to just look at these, again, if we're going to compare apples to apples, if you were just to look at these individually, which would you prefer? And again, this is just simple math from my perspective. One grows better than the other. Well, that's one of the reasons why growth potential. The other reason why we want to use IUL, again, I go back to that word indexed. What does that even mean? And so it relates to security, meaning at my age, I'm 51 years old. At my age, the last thing I want is a loss. The last thing I want is for us to change presidents in November if we do, and then the market does whatever it does, and I lose 24, 34, 54% of what I've accumulated in the market. So I look for protection. I look for security. So why would we want to use a SKIA in the form of a leveraged IUL? It's the security part. And here's what I mean. That whole life policy that I'm referencing, it has guaranteed growth for life, which is awesome. Meaning it's a fixed 4, 3.5, 5%, whatever it is. That's awesome. When you have your money tied up in the stock market, what you're dealing with is variable growth, meaning there's no security. Your ability to lose at different points is significant. So depending on who sneezes in the market or who takes some action that causes an adverse reaction in the market, you have the ability to potentially lose your money when you are tied up in, I'll call it market-based products due to its variable performance. But why are we using an IUL, an indexed universal life insurance policy? It's because of the 0% floor. What the indexed vehicle offers is the ability to not lose. So notice, if I'm if I made money with the market here and all of a sudden the market crashes, what happens inside of my policy is I get to keep what I've made. So I don't lose. And then when the market takes off again, I start from where the market ended, and so I'm able to still perform with the market. I'm still able to take advantage of the growth in the market. But whenever the market dips, I don't participate in any of that. It's secure, meaning the principal and the growth that I've made year after year after year is protected. And we'll get into some of those details, but my point is the reason for using this over this is the ability to produce compound interest. And all compound interest is your money making money, and the money that your money makes more money. So, going back here. So, why is this why this skier grows faster, or why this specific life insurance policy grows faster? We have to dig into some of those details. And again, all I'm talking about is a leveraged IUL, meaning this product is an IUL. So what we're actually comparing today is an IUL compared to an IUL. So what is it about a leveraged IUL? Well, you've got your contributions, and those contributions are protected by a 0% floor, meaning if the market crashes, I don't lose what I've created. I don't lose what I've contributed to it. I just may not participate in any growth that year. So I'm protected. My principal and my growth are protected. Well, at some point inside of this product, there's going to be a match. And when that match is added, I have my contributions working for me as well as this match amount working for me. And most of us understand what I mean when I say match. Think of your traditional retirement account. Compare your traditional retirement account that you have with your employer. Let's call it a 401k. Imagine a 401k with a match compared to a 401k without a match. Which is better? And what do I mean? Well, with your 401k, your money's tied up in the market and is growing and is producing you hopefully retirement income. If you have a 401k without a match, it's solely dependent upon what it is you're contributing. Whereas with a match, that means the company is participating in helping you grow your income faster. Well, this happens inside of this product as well. You have your contributions that you're putting inside this product, and then at some point, there's an additional dollar amount being added, being leveraged to help your account grow even faster. So if you take this away, this is just an IUL. But if you add, matter of fact, imagine adding this to a whole life policy. Imagine adding this to anything. If you add any additional growth, if you add someone else's money into any process, you have the ability to make more than you would without it. And that's all we're talking about here. This is not hard. And this is also why when I speak to other life insurance providers who don't really understand this, it's this piece that when you add this to anything, I don't care what it is, call it an annuity, call it a whole life policy, call it a 401k, call it an IRA. When you add someone else's, call it real estate. When you add someone else's money and you add that money and it's secure, it can't do anything other than help you make more money. So my point is this leveraged IUL is about structure. But what is that structure? So that structure that I'm referencing is purely about a max funded option B IUL with leverage. So anyone who has a life insurance policy or knows someone who generates and or sells or creates life insurance policies, they can provide you a max funded policy. What do I mean by max funded? Max funded just means you're purchasing the least amount of life insurance legally possible. Why should you care about the structure of your policy or making sure that the structure of your policy includes you buying the least amount of life insurance legally possible? Why should you care about that? The less life insurance you buy, the less expense to you. The less expense to you, the less money you're paying out to the life insurance company, which means you have more of your money available to now produce compound interest. The whole point and purpose of this product is so that you make money. So if you're spending less, that gives you the opportunity to make more. So it's about being max funded. And then it has, and again, if we're talking about growth, it needs to be option B. What does that mean? And we talked about this last week. There's an option A policy, there's an option B policy. Option B is just simply saying, as you contribute to this policy, you're building cash value. And as that cash value grows, your death benefit increases. Death benefit is just the amount of life insurance you purchase plus the cash value. So as you contribute to this policy, the death benefit continues to get larger every year that you contribute more and more to this policy. Why does that help you? Well, more that cash value that's available, you get to leverage, use, borrow against, use as income for the rest of your life. So max funded assists you. Option B assists you. We've already talked about an IUL where you're leveraging an IUL because of the security, because of that 0% floor and that growth potential. And then the leverage piece, the use of other people's money. So this is all about structure. Anyone who offers an IUL, can they offer you this structure? Well, three-fourths of it. Meaning they can get you a max funded option B IUL, no problem. The question is, can they add the leverage to your policy? Ask them that question because there is a specific process that has to be done in order for you to add leverage to a properly designed life insurance policy. So my point is we're going to kind of break down today an actual example, and I'm just going to piggyback off the example that we used last week. Let me go back and kind of just restate that real quick. One moment. So if you remember, and I didn't even erase the writing from last time. If you remember, we were talking about a policy for a gentleman, 38 years of age, putting in 4906, and I know it's a weird number, but 4906 every year, which is like 408 and like 10 cents every month. And this is the whole life policy that he wanted me to review. And so what we acknowledged was when you put in 4906 in year one, how much cash value do you have? 3701. Well, the difference between the 4906 and the 3701, that's 1135, meaning he put in 4906 in year one. He's got 1135 in something taken out of his account, which leaves him with cash value of 3701. The question was, if I was to design if I was create a properly designed a SKIA, a properly designed leveraged IUL, what is that performance compared to this? And so we went over here to that SKIA and we did the exact same thing. It's the same 4906 being placed into this product. If you come over here to the accumulation value is 4396. So 4906 minus 4396, you end up with $510, meaning the difference between 1155 and 510, this is what a properly structured, properly designed policy looks like. And then we dug into, well, when the leverage kicks in year three, what happens? And that's what we're going to do today. We're going to break down putting in the 4906 year after year, but when the leverage kicks in, how does this product change? So let's dig into those details. And before I do that, sweetheart, any questions before I continue?
Nope, no questions yet, but I do want to point out that the majority of people who are calling you are to review their policies are from they have a whole oh, what happened? They are have a whole life policy or have just been pitched, I guess, a whole life policy. So they're
Yep.
bringing this to you going, "Hold on a second. The person that I talked to, they said that this was the best I could get, but what you're showing is something completely different. So why are one of these things is not like the other? Why?" And so that's really what it is. A lot of people are uh, hearing about whole life policies because maybe they came in from velocity banking and they heard about infinite banking and this vehicle. One thing that you didn't cover when you were talking about leverage and the different terms was where leverage is. Even inside of a whole life policy, it's the concept of infinite banking is still leverage, right? We
Sure.
understand how powerful leverage is, and if you're just learning about velocity banking or you're already down that path, then you also understand that leverage is really the most powerful element of velocity banking. So where we can use leverage, it's important to identify where it is and how it's functioning, right? So the one thing I just wanted to point out is a lot of interest comes from whole life people with whole life policies. Now, I do want to say this before people feel like I feel like I made a bad decision, I don't want to watch. That's not what this is for. It's
No,
not to
not at
make you
all.
yeah, it's
No.
not to make you feel bad. It's not to point out or say there was some mistake made. First and foremost, any life insurance is better than no life insurance. So we want to get that out the way for sure. The second part is sometimes it's better to become educated so that you understand what your options are and where the rest of your money could go, right? So even if you have gone down the road, the worst thing you can do is continue down the wrong path enthusiastically, right? Or feel like you have to continue choosing that path. There are options. We just don't know what we don't know sometimes. So that's I just wanted to put a pin in that here at this point, just in case anybody was feeling like, hold on a second, maybe it's not worth it for me to learn because I already have this type of policy.
Right.
That's all.
And along those lines, we don't know what we don't know. And there's the whole point and purpose and objective here is to simply educate, meaning kind of peel back the curtain and understand why. So that way, when you are having these discussions or you're trying to decide what path you should go down, I just want to make sure you have all of the proper information available to you.